Here's a mistake almost everyone makes. They think if I own shares, I'll get dividends. Sounds reasonable, but it's completely wrong. Let's break the one rule about equity that changes everything. Characteristics of equity securities. Question 10. A financial analyst is explaining the features of common equity to a client. Which of the following statements made by the analyst is least accurate? Common shareholders have a residual claim on the company's assets in the event of liquidation. B. The payment of dividends to common shareholders is a legal obligation that must be fulfilled each period. C. Common shareholders typically have the right to vote on major corporate matters, such as the election of the board of directors. Correct answer, B. Just so you know, companies aren't legally required to pay dividends on common shares every single time. The board of directors is the one who gets to decide whether to pay dividends. Unlike interest on debt, if a company misses a common dividend, it doesn't mean they're in default or going bankrupt. Companies can cut, pause, or even stop paying common dividends without any legal trouble. When a company issues stock, they're not legally bound to pay regular payments to shareholders. A. Incorrect. Common shareholders have a residual claim, receiving assets after creditors and preferred shareholders. C. Incorrect. Voting rights are a core feature of common shares, allowing participation in governance. Question 9. A company is holding its annual general meeting to elect 5 members to its board of directors. A minority shareholder who owns 200 shares wants to concentrate all of his voting power on a single independent candidate. Which voting arrangement would best allow him to do this? A. Statutory voting. B. Proxy voting. C. Cumulative voting. Correct answer, C. Cumulative voting lets shareholders boost their voting power by multiplying the number of shares they hold by the number of directors up for election. This means they can distribute their votes in any way they see fit. For example, if a shareholder has 200 shares and there are 5 directors to choose from, they'll have a total of 1,000 votes, 200 shares times 5 directors. Cumulative voting lets shareholders use all 1,000 votes to back one independent candidate. This approach gives minority shareholders a boost in voting power, as they can put all their votes behind a single candidate, which makes it more likely their favorite will get on the board. A. Incorrect. Statutory voting limits minority shareholder influence by requiring votes to be evenly distributed across all candidates for each director position. B. Incorrect. Proxy voting allows shareholders to authorize someone else to vote on their behalf at annual meetings, but it does not change the voting power distribution or provide a mechanism for concentrating votes. Question 8. An analyst is preparing a report on the capital structure of a stable utility company. The company has issued non-callable, non-convertible preference shares. Which of the following statements about these securities is most accurate? The dividend rate on these shares will fluctuate directly with the company's annual earnings. B. The holders of these shares have a legal claim that ranks above all creditors in the event of liquidation. C. The holders of these shares are entitled to receive their fixed dividends before any dividends can be paid to common shareholders. Correct answer, C. One of the most important things about preference shares is that they always get paid dividends before common shareholders. This is true no matter what other perks they might have. Preference shares are always paid dividends before common shares. Just a heads up, preference shares with fixed dividends need to be fully declared and paid, or, if they're cumulative, accrued before any dividends can be given to common shareholders. This rule applies to both cumulative and non-cumulative preference shares in the current period. Even if the shares don't have call or conversion options, the priority for dividend distribution stays the same. Preference shares get paid dividends before common shares. A. Incorrect. Non-callable, non-convertible preference shares pay a fixed dividend, unlike common share dividends that fluctuate with profits. B. Incorrect. Preference shareholders are paid after creditors and debt holders in liquidation. Preference shares are equity, subordinate to creditors and junior to all debt forms despite debt-like features. Question 7. An investor is comparing two preference share issues from the same company. The first is non-cumulative participating, and the second is cumulative non-participating. If the company suspends dividend payments for a year, which class of shareholders will have their unpaid dividends accrue and be paid in arrears when the company resumes payments? A. The holders of the non-cumulative participating shares. B. The holders of the cumulative non-participating shares. C. Neither class. Preference dividends are forfeited if not paid when declared. Answer B. Cumulative preference shares have a key feature. Unpaid dividends keep building up over time. If payments are paused, these unpaid dividends turn into dividends in arrears, which need to be paid before any common share dividends can be distributed. The company is committed to paying these accumulated dividends when it can, no matter how long it takes. This gives investors a solid safety net against short-term financial troubles for the company. The non-participating part just means they don't get extra money from profits beyond the regular dividends. It doesn't change the fact that the cumulative dividend is still there. A. Incorrect. Non-cumulative shares forfeit unpaid dividends if not declared on time, unlike cumulative shares. C. Incorrect. The answer is incorrect because it ignores the legal distinction between cumulative and non-cumulative preference shares. Cumulative mechanism. Think of it like a savings account where you earn interest on your missed payments. This gives you a priority claim on the company's future earnings until you pay off what you owe. Usually, this stays in place unless the shareholders decide to change it. Non-cumulative reality. Each dividend period is its own thing. Missing payments don't mean you owe more in the future. Shareholders are willing to take a bit more risk to get the chance for potentially bigger returns if they choose to participate. Participation feature. This feature only kicks in when the company is doing exceptionally well. It doesn't affect your basic dividend rights or how dividends are calculated. It can be applied to both cumulative and non-cumulative shares on its own. For investors, think of cumulative shares as a steady stream of income. Non-cumulative shares might offer a bit more in return, but they come with a bit more risk. It's important to look at the participation feature on its own, regardless of whether the shares are cumulative or non-cumulative. For companies, cumulative shares mean you'll have to pay out more in dividends in the future. Non-cumulative shares give you more room to maneuver financially. Participating shares can help make sure your investors are on the same page as how the company is doing. Question 6. In a company with 10 million shares outstanding, a group of minority shareholders collectively owns 400,000 shares. There are 5 directors to be elected. Under which voting system is this group most likely to gain representation on the board? A. Statutory voting. B. Proxy voting. C. Cumulative voting. Correct answer, C. Cumulative voting is a tool that helps minority shareholders have a stronger say in board elections. It works by letting you focus your votes. To figure out how many votes you have, you simply multiply the number of shares you owned by the number of directors up for election. You can then use all those votes to back one candidate or a few. This way, a group of minority shareholders can work together to make up for the fact that they don't own a huge chunk of the company. By uniting their votes behind a single candidate, they can effectively counterbalance a majority shareholder who might be casting their votes too broadly across several candidates. The main advantage is that it opens up the possibility of having a more representative board than what's permitted by the law. A. Incorrect. Statutory voting disadvantages minority shareholders by preventing them from concentrating their voting power, allowing majority shareholders to win all director seats. B. Incorrect. Proxy voting allows shareholders to authorize another person to vote on their behalf, but the proxy must follow the existing statutory or cumulative voting system. Question 5. An investor is considering purchasing preference shares in a high-growth technology startup. Which feature would most likely make convertible preference shares more attractive than non-convertible preference shares for this investor. A guaranteed dividend payments that must be made before any interest on debt. B, the ability to convert into common shares and participate in future equity appreciation. C, priority over bondholders and liquidation proceeds. Correct answer, B. It highlights the special advantage of convertible preference shares in a booming market, the chance to share in the company's growth. Usually, tech startups that are doing great reinvest all their earnings to keep growing. So, the regular dividend from a preference share isn't usually the main thing investors think about. Instead, they're mostly interested in the possibility that the company's worth could go up a lot. The conversion feature is a great deal for the investor. It gives you the security of a preference share, meaning you get priority over common stock for dividends and assets. But it also lets you enjoy the full potential of a common share. If the company does well, you can convert and benefit from the increase in the common stock price. That's why convertible preference shares are a popular choice for companies with higher risks when they're raising money through venture capital and private equity. A, incorrect. Preference shares have two fundamental errors. Dividends are not guaranteed, and the feature is common to all preference shares. C, incorrect. Preference shareholders are paid after creditors and before common shareholders in a liquidation, regardless of whether the shares are convertible. This is a fundamental aspect of capital structure. Question 4. Compared to non-participating preference shares, participating preference shares are most likely to provide holders with the right to receive A, voting rights in all corporate decisions. B, additional dividends beyond the stated preference dividend when profits exceed a specified level. C, priority in the distribution of all corporate assets ahead of all other security holders. Correct answer, B. In this situation, participating means you get to share in the company's leftover profits, just like the regular shareholders, once the fixed preferred dividend is taken care of. This is what sets participating preferred shares apart from regular, non-participating preferred shares. Non-participating shares only get their fixed dividend, but participating shares can earn an extra, variable dividend. This makes participating shares a good choice for investors who are looking at companies with good profit potential, even if it's not guaranteed. A, incorrect. Preference shares generally lack voting rights, making the attribution of such rights to them an exception. C, incorrect. Participating preference shares have a priority claim on assets over common shareholders in liquidation but are subordinate to debt holders. Their defining characteristic is the right to extra dividends, not a priority claim over all other security holders. Question 3. Which of the following statements best captures the hybrid nature of cumulative, non-participating callable preference shares? They obligate the issuer to pay dividends before interest on subordinated debt, and failure to pay triggers default. B, they provide fixed dividend payments and priority over common shareholders in dividends and liquidation. But dividend payments are not legally enforceable and do not confer voting rights. C, they are treated as liabilities on the balance sheet and amortized over time like bonds. Correct answer, B. It points out that these fixed dividend payments, like the fixed coupon payments on a bond, and priority over common shareholders for both dividends and assets, similar to a bondholder's seniority over equity, are what makes them so appealing. It also rightly notes that these attractive features come with some equity-like risks. The dividends aren't legally enforceable, unlike bond interest, and the shares usually don't give you voting rights, a big advantage of owning common equity. This statement really gets across how the security is both a safe, income-generating investment and a way to own a piece of the company, not just a loan. A, incorrect. The text highlights two errors regarding capital structure hierarchy and dividend legal status. Debt holders, including subordinated bondholders, have a senior claim to equity, and preference dividends are discretionary, unlike debt interest. C, incorrect. Preference shares are classified as equity, not liabilities, and are not amortized over time. Question 2. Which of the following statements concerning callable preference shares is most accurate? Callable preference shares provide benefits to both the issuing company and investors because the call feature allows investors to participate more fully in the appreciation of the underlying common shares. B. The call feature in preference shares primarily benefits the issuing company by providing the flexibility to redeem shares when interest rates decline. C. Investors holding callable preference shares would generally prefer statutory voting over cumulative voting to ensure greater representation on the board of directors. Correct answer, B. A call option on preference shares lets the issuer decide whether to buy back the shares at a set price, but they don't have to. This is a big plus for the issuer because they can buy back preference shares with high dividends when interest rates drop and then sell new shares at lower rates. This helps the issuer save money on borrowing and reorganize their money in a smart way. It also keeps the best part of the deal for investors, so the issuer doesn't have to keep paying dividends that are too high. Investors often have a bit of an edge over issuers because their potential returns are capped by the call price. They might need to reinvest their money at lower interest rates, which can be a risk. To make up for these uncertainties, callable preferred shares usually pay a higher dividend. Callable preference shares tend to give the issuer more control and benefit. Investors who hold callable shares usually want higher returns to make up for the issuer's control and the limited potential for gains. A. Incorrect. Callable preference shares restrict appreciation, unlike convertible preference shares, which allow upside participation. C. Incorrect. Calibrate and voting systems are separate topics. Preference shares lack voting rights, and cumulative voting improves representation for small shareholders. One crucial question. Question 1. In the event of a company's liquidation, which of the following accurately describes the priority of claims? A. Subordinated debt holders are paid after common shareholders, but before preference shareholders. B. Preference shareholders are paid after all debt holders, but before common shareholders. C. Common shareholders are paid after subordinated debt holders, but before preference shareholders. Correct answer, B. When a company is liquidated, it means it's been dissolved, and its assets are sold to pay off any outstanding debts. After the assets are sold, the remaining value is distributed according to a legal order that tells us who gets paid first in what order. This order is based on how much risk each group of people has taken, which is really important when we're figuring out how a company is structured. Preference shareholders are like the first line of defense for equity investors, but they get paid before common shareholders when the company's assets are sold. Preference shareholders get their share of the distribution first, up to what's called their liquidation preference. Usually, that's the par value of the shares, plus any dividends that haven't been paid yet if the shares are cumulative. Even though preference shareholders get paid before common shareholders, they're still second in line to all the debt holders, including secured, unsecured, and subordinated debt. That's because debt is just a promise to pay money back. So when things get tough and we have to liquidate, the order of priority is as follows. First up are the folks with secured debt. Next are those with unsecured debt. Then we have the subordinated debt holders. After that, it's preference shareholders. Finally, we get to the common shareholders. Preference shareholders are a bit less risky than common shareholders, which is why they get a higher priority claim in liquidation. A. Incorrect. Subordinated debt, though ranked below senior and unsecured debt, is prioritized over equity investors in bankruptcy and liquidation. C. Incorrect. Common shareholders as residual claimants receive payment last after all other parties in the capital structure. Concept. The order of claims shows how risk and return are balanced. Claims with higher priority are safer and offer less return. Claims with lower priority are riskier and offer more return, which is why common shares usually have the most potential for growth, but also the most risk.